Hi everyone, today is December 17th and this is our final class of the Wyckoff Practicum. This is the last session of the Practicum as we know it. It's going to become WTC Part 2, but we're still going to call this Practicum because this is where a lot of the thinking is happening. This is where a lot of R&D is happening as well. It's just when students go to the level where they understand the material better and much deeper, they obviously have different questions. And that's how this R&D kind of happens. In a way, me and you have a very symbiotic relationship. I give you some knowledge that has obviously a lot of blind spots, and then you ask questions about those blind spots. I address those, but by addressing some of them, it opens up other blind spots. So you kind of could see this perpetual, symbiotic push and pull. What about this? What about that? Well, let me go and research on this. And then I'll come back to you. And when I come back, you usually guys are going, okay, well, that was great. But what about this? So it kind of never stops. And it always amazes me, for almost 10 years now that I've taught officially, it's always been like this. So I came to a realization, I want to share this with you. I have a non-verbal contract with all of you, my students. And that contract is basically you give me an opportunity uh, to go and research stuff and bring this stuff to you. And you require so that I would explain that. So that's kind of like my job. My job as a teacher is to go and to find, those, what I call them, moments of truth, like uh, some secret that, needs to be uncovered. And my responsibility is just to do that and then to give this to you. So kind of like that's my purpose. Um, and I'm really happy to do this. It brings me a lot of pleasure, to do this. All right. Well, that was a little bit out of the way, but I guess I'm a little bit sentimental because this is the last class, and we had it going so well. I think this was probably one of the best practicum cycles that we've had. I think your insistence on the uh, d details of the bias game was one of the greatest moments of this cycle for sure, and I'm looking forward to see how that's going to transpire, going forward, because the more we do bias games and the more you guys are kind of like pushing the whole process to a very structured way, the more clearer the solution is. I basically kind of see where it's going from here. We're going to have a step-by-step for the bias game. And we have rule number 1. Go left to right. Create your story from left to right. Use all of the information that you have. So that was a really great moment in the class, in this cycle. Um, I really, really liked and appreciate also all of the honest and sincere, straightforward emails that I've got from you guys about where you are in trading, what bothers you, what you think, we should be studying in the class. And I'm always listening. Sometimes, I just take it as a note, and sometimes, I drastically change, the way how we approach it. So in a way, again, I'm talking about that relationship that we have. You're driving the product, so to say. You're kind of like dictating what is the next blind spot that we have to go to and uncover. Uh, so I really appreciate that. Okay, what else? I think anatomy of the trade was also interesting in the way how kind of did not start really well, but then, once the selection was good, then we went into the understanding of, okay, well, this is the trade and this is how it unfolds. Um, uh, there were probably I would try to figure out how to include more exercises on more different themes. Um, so maybe in the next cycle, that could be my focus. So kind of like contemplating and thinking about the next cycle. What else is going to happen in the next cycle is that once the new website is launched, then we are going to have the capacity to communicate with each other via forums. And one of the forums is going to be a closed out, protected forum for WICA Practicum students. And you guys will be able to talk to each other, post any charts, discuss any homework that we have. And because it's closed, only you in the classroom is going to see this. Actually, I probably will be kind of like uh, thinking that for those of you who would like, you could post your bias game, when you're done with that. And then, other people could have a look at that work if you'd like, because I can't really, do all of this, put all of your homeworks on the slides, but this could be the way. And then I had so many requests from you just to connect. So we're going to do exactly that. All right. What else is here before we go to our agenda? Long-term campaigns. I thought the first session was great. Um, a lot of new material. The way how showing I'm showing kind of like the uh, price cycle and how we're gonna put the coordinates there. And I gave you guys, like a very, very defined signal as to look for this. And then you had a homework. So for those of you who still want to participate, this week is the last session, but you as always, you could buy it on demand. The practicum, and this is very serious, and I've already seen 3 people who signed up, for alumni who signed up for the practicum again. Well, first of all, very smart because it's an early bird, so please do that. And then I'm kind of smiling a little bit because you see what's going on. It's like this game never ends. Each week you could analyze the chart and you could come back to the class and just listen to the explanation or just watch for that explanation. And I think that the key, especially for those of you who have jobs from 9 to 5 and you guys are so busy with other stuff in your life, it's very difficult, and I totally get it. There are other things than the market, and I'm devoting, a lot of time during the day to the markets, from any aspects of it. So I'm going to take myself out of this equation. But there are some things in life that I really, really would like to do. And my job, which is the markets, does not allow me to do so, right? So having just one class a week, it's a structured way to kind of still keep going and keep improving. And with each week, to think about those concepts, to improve your thinking, to look at some examples, and it's still gonna benefit you in the very long run. So I could see how some of the people are kind of like, jumping, from one cycle to another into another. It's just because it just never stops. So you can never stop your improvement. All right, so register for the practicum if you intend to do so. Also consider WMT if you're not a subscriber. Also, if you would like to repeat WTC course, that's available as well. And there are some very exciting products in 2020 that are coming out. You guys are on our newsletter distribution list, so I will inform you this way. But one thing to pay attention, actually two things to pay attention to for sure, is the trust the process, continuation of that, and then also the scanning, which I think that, we are consistently now developing this methodology and knowledge. And in my work with John, I'm making sure that there is that consistency of the progression. So if you start from the beginning, from the first specials, from the very basic syntax, the basic understanding, and I would take first even November special just to understand the momentum in general, and then jump into the scanning. Then we're going to have part 2 and also a very, very advanced part 3. So it's just exciting where we're going with that. And trust the process, that's going to be a complete thing. I kind of like have a specific vision for that as well. We have, Teresa working on that, and she's doing just a spectacular work. So somewhere in the first quarter, we're going to have that special too. Today, and it's session number 15, by the way. Right, it's not session number 14. I just don't want to say goodbye. We have a special presentation by Ted. Ted is going to be showing his way of defining and looking for sprints. So that's going to be very interesting. Then a quick market update, anatomy of the trade update, bias game, last bias game that I'm gonna give you guys, and then you're off to races with the Twitter. And on Twitter, free each week, same bias game. We give you the explanation as well, so you don't have to be in class. At least do that. That's very educational. But if you want more details, obviously, just sign up for the class. Q&A, because this is the last class. We didn't have a lot of questions, although we've addressed so many during the course of this semester. So I'm satisfied with the Q&A in general. And then there are some exercises that are left on the bias game or the tape reading, and we'll see which one you guys will choose at that moment. All right. As usual, everything that we talk about here is for educational purposes. Stop your recording, read the disclaimer. And with this, let me introduce you to our today's presenter. Ted, are you there? I think that you have to unmute yourself.
Let's see, is this working now?
Yes, I can
hear
good.
You now. So isn't this amazing?
Yes.
I'm on the side of the road driving to Chicago.
Yeah, and it is amazing. Yes, and I'm so happy that you could make it with the with this technology that we have. So that's great. Ted, I wanted to, and I kind of prefix this by that you're gonna talk to us about sprints. So you sent me an email where you were showing a case study, so to say, on a sprint, and it kind of got me interested, and I thought it would be valuable for our students, to hear this.
Sure.
So,
well,
walk us through this.
Well, let me make a few prefaces. I'm an old student, not a very good student. Took the course from Craig Schroeder in 1982. And the only, not being a good student, all I came away with was springs and up thrusts. I didn't understand the A, B, C, D, E. That's why I took the course from you probably 9 months ago, to understand more about Wyckoff and to have more points of entry, because good springs don't occur that often in the market. Mm-hmm. So I put this.
And how was the course for you, by the way, Ted?
Oh, I loved it. Mm-hmm. I loved it. It'd be now, and I'm going to go back through my old, I still have the old original course,
Hmm.
and I'm going to look for the A, B, C, D, E that I must have missed back then. But it certainly has given me more places to look for entries. I never would, not, I didn't buy NVIDIA,
Hmm.
but I could see what a great trade that was after, I think it had made a spring. I don't have the
It
chart in
was
front of me, but
attempting, yeah, it was a high low. It was attempting to spring, and it had
it
all
didn't
the,
make the spring.
yes, it didn't
Yeah.
make a lower low, but let's also, because we're here in the advanced class, let's just remember that NVIDIA on the way to that phase C had characteristics that it wanted to spring, the way how the
Hmm.
spread behaved, the way how the volume behave. And that's the main recognition that we should have, on that type of the reaction that goes into spring. And it just failed to spring.
Didn't spring. And then you missed, so you wouldn't have bought it there, but on the, there's other places as it was unfolding that you could have jumped in and made a very nice trade still,
Hmm.
which is still unfolding. So I put these, I'm a investment advisor, work for a large firm in Cleveland,
Hmm.
and was an institutional salesman for many years, selling research to institutions around the country. So I got to see how large institutions work.
Hmm.
There's portfolio managers, there's analysts, and there's trading departments.
Hmm.
And so it's kind of fun to see things unfold and imagine, as you're talking about how institutions look at things, and then try to imagine how things are working inside of those institutions. But so you're on the first part of this PowerPoint, and I think there is a Wyckoff admonition that says, "Beware of springs and downtrends," and that's correct because they often fail. But to buy a spring or to get into a spring position, the stock has to be a little weaker than the market and has to be in a downtrend of some kind. But I would say that you wait for a spring to get to a really big spring position. Maybe you're springing support from 2 or 3 years ago, and those are big springs. So if we go to the let's go to the next. Can you go to the next slide?
Hmm. Here we go.
And of course, really good springs come in down markets, which of course is when it's really hard to buy a good spring, and that's probably what takes all the practice. But a good spring, in my opinion, is the danger point. It's the danger point that Jesse Livermore would talk about. And I've found that in a really good spring, most of the gain comes in the automatic rally after the spring is made. And we'll see that in just a little bit. But if we go to the next slide, here's Lyondell. Now, I kind of like dividend stocks because I think a good dividend puts a natural floor underneath a stock. But you can see this wonderful spring. Bruce Fraser was talking about that switch from growth to value back in August, and he had that chart, growth versus value, on stockcharts.com, and it kind of shows you when the values was started to get weaker, and the do you remember that chart he had, and the value stocks were getting stronger? Well, that all happened right back in August, right when this spring in Lyondell occurred. Now, another spring in Caterpillar. There were a lot of large springs right in that month. And you can see Lyondell is springing support, 4 years of support. And down there in that spring at $69, it was yielding 6.75. It was yielding 6% or so. So to me, that's kind of what I like to buy. If we go to the next slide. At the same time, this is Caterpillar. This is the spring in August. You see a nice trading range, and we see the stock is now down at that spring position in August. And what a wonderful thing that's been. It's up 27% from the spring. Now, Roman, you probably wouldn't buy that spring. You'd probably wait for the automatic rally and the test and all that. Um, and that's fine. But sometimes I would jump in right there because most of the gain is made in the recovery from the spring.
Right. Well, Ted, I don't know if you want the questions afterwards or during, because yeah, that kind of, uh, you know, the question is asking itself, why do you think the majority of the gains come right after the sprint? What you're calling an automatic rally here after the sprint, probably we're referring to the sign of strength here. So why would the
Yes, that's the
majority,
sign of strength.
yeah, so why would, in your opinion, why would the majority of the gains would come quickly after the sprint?
I just noticed that in a good spring, the rally after the spring is kind of sharp,
Mm-hmm.
and that's and then when you jump in later on, well, maybe a good bit of the move has already been made, and
Right.
it's more of a slog after that.
Mm-hmm.
So that's
Yeah.
that's why I
Yeah.
think that.
Can I really quickly tell you my opinion why this happens?
Yeah. Yes, please.
Okay, so this is a very good observation, but we also want to understand, what happens there, right? So when we look at the volume signature throughout the whole trading range going into phase C, we kind of see a lot of buys as value buys. So they are buying at the bottom. They are buying like at the climactic action. Then they are
Yes.
buying maybe like at the bottom of the sprint of the secondary test, I'm sorry. And it acts as a sprint, right? Goes down, quickly up. Then
Hmm.
another kind of type of sprint at this support level. We're looking just at this support level. Goes down, there is a little bit of the increase in the volume signature. They're buying right here. So we could establish like this value zone for institutional buyers where they buy it. And then by the time that they have bought this position into phase C, we could see in the volume signature that supply has diminished. They have absorbed supply. It's visible from the volume itself and from inability of the price to commit seriously down. So then
Hmm.
what happens next? We don't
Well,
have,
first,
yeah,
now that the spring in August, is
uh-huh,
that point C?
yes, right here,
That's C.
let's see.
That's C right there. Okay.
Yeah, and we
Yeah.
could actually include this test into C. Why?
Hmm.
Because we usually would be thinking that with the local increase of the supply, there's going to be some kind of testing action that should happen on the lower volume signature and then as a higher low structurally. So that's what we're
Hmm.
looking for. So we could include both. Um, and then imagine that this supply has been observed. It's much easier for the price to move up. So now we have momentum on our side. And not only that,
Yes.
there are fewer shares that are available because of this absorption, so they have to bid up the price. And that's when the move starts to happen much faster. And off the spring, we usually will have that momentum. Now, what happens afterwards, in some cases, whenever we've done sign of strength, then they're saying, well, we bought in on the way up. Now we're not going to do anything. We're going to become inactive. We're satisfied.
Yeah.
We have a meaningful position. If we're going to see some short-term value, we're going to step in. And that's why the price starts to kind of like drift into the backing up action. And as they see some short-term value, that's when they start, okay, we're going to pick up a little bit here, a little bit here, a little bit here. Now we're kind of like supporting this ground because our short-term valuation is here. And that absorbs final supply at this level, and then that moves the price up. This advertises the trend, and then more institutions jump on this train because their systems are saying, what, 52 weeks high, momentum breakout, and so on and so forth. So all of these institutional trend followers are jumping on the train, and obviously it becomes a trend. But it all started with this spring,
With the spring.
with this spring.
And the problem is you don't have a beautiful formation like this very often.
Mm-mm.
I mean, you can look for these and look for them. There's not that many of them,
Mhm.
but when they're there, they're pretty good. Um,
Right. Hmm. Okay.
let's going to the next. The next one is eBay. This is years ago, not that many years ago, but I always thought here we have a nice long trading range, and I kind of look at the bottom of that range as the bid side of the market in a big kind of way. That's the bid side, and the upper range is the offered side in a big kind of way. And this is where all the big boys, the big portfolio managers, and I used to call on them. This is where they're kind of placing their orders in a big trading range like this. So I just now eBay went on to much. This was reaccumulation, and this went on to much higher highs after 2015. I don't show it to you in the this chart. I'm just showing you that particular trading range. The next slide, somehow I went back to Caterpillar, eBay. Oh, so Roman, you said in one of your
Hmm.
classes,
Hmm.
and this is flip down to the next,
Hmm.
flip down if you would. It should be TLT.
Yes.
Yes. All right. So you said, and this explains things perfectly, that a climax is a liquidity event.
Hmm.
So you shouldn't fear these things. Um,
Hmm.
and I can just imagine what goes on inside of an institution. And you've been trying to buy this stock all year long. You can't, if you're a big institution, you, you just can't buy that much stock and not move the price.
Hmm.
And so you kind of divide up your purchases and you kind of wade into a stock and you wade out of a stock. And, and then suddenly you've been trying to buy this stock all year. And then finally, wham, it's down 5 or 6 points on some sort of bad news, huge spread going down, lots of volume. And the trading department's calling up the portfolio manager saying, look, you've been trying to buy this all year. Here, you can have all you want at down $5 from the last price. And they're finding the other sides of these trades. And so the portfolio managers, if nothing really is that different about the company, they come in and make their purchases. As we can now, this isn't a stock, TLT's, long treasuries, but it's the same. I was just looking for an example of a nice big climax where the climax stopped the move. And this is what happened in the ETF. And then this is back in August, September and October of 18. Then we had a very big rally for bonds um, in TLT, or as shown by TLT, I should say. And then we had another in August of 19. We had a buying climax, and as I was watching that, you just knew, oh, this is the end of the rally
Hmm.
because we had this big climax, and everything that was to be bought and sold is bought and sold right then, and kind of everything's cleared out, and we've marked the end of a rally. So now this is probably going to mark a nice trading range, don't you think,
Yeah.
Roman?
Yeah, absolutely. I mean, that was described perfectly. The rally itself had kind of like, that those characteristics that we've talked about, guys, in Best of Wyckoff. I've talked about first the momentum off the floor, right? So where we have that volume signature, there's a lot of buying orders that moves the price freely up to the sprint. Ted has described the sprint process to us. Then we go into the second section where we have profit taken on the way up, and that kind of has more reactionary mode, but it's still upsloping. It's a vertical absorption. Whatever profit taking is happening, other institutional interest believing that the valuation is still going to be higher, and they are going to absorb that supply by stepping in and buying. that supply. And then once supply has been observed, first at the low level, at the level of the backing up action, then on the way up, there is nothing left. And we have a pure speculation, and actually there is nothing to fear about the buying climaxes. In fact, you should be looking at the opportunity as a speculator, and I'm talking to those of you advanced students who are speculators, to take this and to take this. Unfortunately, I did not take the move up, but when I saw that it's climacting like this, my entry was here and I got out somewhere here. The purpose of this trade was not to have a very long-term, short-oriented position. It was just to capture the initial momentum, to capture the initial volatility in a very shortest period of time, make a relatively good return. And that's what kind of like was achieved with that trade. Ted?
Yes. So this illustrates climaxes at both ends of a move.
Mm-hmm. All right.
Now, too bad we're a big bond firm. Too bad we didn't really act. We didn't do anything right there.
You didn't hedge
Usually,
at the top.
you're too scared to death.
But okay,
well, at the top.
okay. Well, let me kind of like interfere here with your thinking here, because I do work and consult institutional clients. So this is a kind of very common dilemma, right? What do you do at that spot at the top as an institution? You're holding a long-term position, So what do? You already have, profits built in. But in a lot of cases, I hear that is that when there is such a strong deviation, in the way how quickly the move has happened, institutions tend to take the profits off the table, wouldn't you say?
Yes, as a bond firm, we have most certainly drawn in our horns.
Mm-hmm.
Because we've had such a great year, we want to preserve it.
Yes.
And so we have, the way you do that in a bond firm is you shorten up your positions.
Okay.
You shorten them up. You can stay in the same corporate bonds if you like the names. You can stay in the same names. You just buy shorter positions because they're not going to be as volatile as a longer bond is going to be.
Right. So in effect, you're making the same trade. You are basically trading this volatility, short-term volatility that's going to occur, and you're using just different, time frame, to create.
Right. As a firm, we're not using charts like a Wyckoff person. And so, I mean, if we were all Wyckoff bond people, well, we would have known what to do.
I see. Okay. Well, hopefully, for your personal purposes and just an understanding, of what are the possibilities here, how behaviors are going to, be exhibited at that buy and stop in action. I think it's useful. All right. Well, what's next for us?
So the next slide. So here's what I emailed you, Roman.
Okay.
And then you emailed me back. So, the one of the few things the market gives you is diversification. So as investment advisors, portfolio managers, you have diversified portfolios. Now, if you become a good Wyckoff trader, you don't need as much diversification because you're more correct more often on your trades.
Hopefully.
But remember, hopefully. But we're trading for other people, so you can't do the things that you would do in your own account. But diversification is one of the few things the market gives you. And so why not have a diversified portfolio of springs? And so from time to time, I sit down in front of the TV and I'm just flipping through. I like to use Telechart because you can just zip through 500, the S&P 500 in no time, just flipping right through. And, I just jot down a number of springs or close to springs or maybe a few failed springs too. So August 22nd, I've done this over the years, so I've got lists from previous years. This is just the latest one. I did not make that list in August. There were some great springs in August. This is October 22nd. And so there were about 7 or 8 stocks that I jotted down, noted. And if we go to the next, well, let me say this. If you put together a portfolio of springs, if you look at the, let's go down the next chart. This is that portfolio of springs. So you can see what the stocks were. Alexion, Clorox, Comerica, Concho Resources, Disney, Devon Energy, EOG Resources, Exelon, and Diamondback Energy. You notice there's a few oil stocks in here because they're all making lows. Mm-hmm. The green line is the composite, is the average of these stocks. The blue line is the S&P 500. This begins October 22nd. And you can see how these springs, how these companies have rallied since October 22nd, responding to these springs. And you can see how the S&P 500 did at the same period. If I were to back this chart up, the composite of these stocks would look terrible. They'd be down 25% over the last 12 months. But then once they hit their spring positions, they start rallying. Mm-hmm. So this chart begins from October 22nd. So there's 2 things I note. One, the springs do better, and they have over, when I've done this time after time, have done better than the S&P. We're investment advisors, so we like to do better than the S&P or whatever our benchmark is. And it also, the springs triggered you into positions. So you got triggered into positions, and you did better than the S&P 500 for this period of time. Now, the effect of these springs is going to wear off over time. So 4 months from now, that green line is probably going to be doing worse than the S&P. Because you went into stocks that are probably weaker than the market in general. They're responding to their springs, but they're kind of weaker than the market. So this effect will wear off after a while, and these will stop outperforming. I've seen that happen in these lists, which I keep. If we go down, so then I put slides in for each one of these stocks. So go down the next one, we'll see Clorox. Clorox is kind of a spring in a what could be an uptrend. That's responding not really well. Oh, and this is at October 22nd. So this is what they look like at October 22nd, not afterwards. I'd confuse everything if I tried to put, October 22nd, then what happened afterwards. But you guys can look it up and see how these responded. The next one is Comerica. That was on this list. The next one is Concho. See, these are all pretty ugly looking at the time. That's what makes them hard to jump into. They're so ugly. Next one is Alexion. Alexion had a great rally after that spring. The next one is Disney, a spring in an uptrend. That one sprung very nicely. Devon Energy didn't quite get to the spring. It started to rally a little bit. EOG Resources didn't quite get to the spring, but it rallied. Exelon, a big utility, and FANG, Diamondback Energy. So so I just put these on. This is what they look like at the time of the spring. And then if you go back up and see the performance of the springs, you'll see that most of them have, in mass, have done have done all right. So that was my story. Oh, one other thought.
Uh-huh.
When you see a bunch of big springs in the market, that could be a turning point in the market,
Mm-hmm.
especially in big stocks. I think the market follows big stocks and big springs in stocks, and that I think that touches off rallies in the market.
Mm-hmm. Yeah, that's a really good observation. I think that we are, through different tools in different classes, we're coming up with the definition of the breadth of the market. So you can use spring as kind of like a breadth indicator of where we are. At the point of the reversal when the market is oversold, and obviously October 22nd is kind of like on that one of the lows there. So we're definitely going to see a lot of sprints there, right? And from there, we're going to have a move up. I think what's valuable, and I would love to hear your thoughts, is definitely emotionally it's difficult to buy a sprint just because we are at the point of danger, right? So it could
Yes.
go either way. It could continue its move to the downside. Usually it's not going to have relative strength. It's not going to have other characteristics rather than maybe like emergent conditions of deterioration of the downtrend, where momentum starts to slow down, maybe where the volume starts to come in a bullish way, and we could start seeing this. But usually it's going to look very bearish.
It's going to
So
look awful.
yeah,
And by the way, these have all worked because we're in a bull market.
yeah,
If we were in a bear market, these springs would
yeah.
not be working.
Here you go.
And that's how you know if you're in a bull market or a bear market.
Right. So you have to pick up the sprints in some kind of market correction. That's when they're going to
Yes.
work the best. So
Yes.
either this is going to be a secular correction like 2009, and those are going to be deep sprints,
Hmm.
but those are going to present the most long-term value. Or you're going to have short-term cyclical lows,
Right.
2010, 2011,
Yep.
2012, 2014, 2015, 16, then 18 on both sides at the beginning of the year and at the end, and then 19. All of those years would have those market characteristics of a cyclical downturn, which recovers in the secular
Which
trend.
recovers.
Yeah.
Yeah.
And
Yes.
usually
And
during those that are usually going to be like 10, 15, 20% down, you're going to find a lot of sprints.
that's when you'll see the springs.
Yeah,
Nice ones, big ones.
right.
Now, if you're incorrect on some of these and you fall below,
Oh my goodness. I
um,
was about to ask you this question. So the
then what
next step,
happens
yeah.
is you have a good chance of a rally back to the ice.
Okay. So you still
Or just,
rallying if sprint fails, right? This should be kind
yes,
of like a title of an article or a blog. If sprint fails, then what are our tactics? We are basically saying that this is, as you said, return to the ice or LPSY rally, but it's
and
still a
let it go.
rally.
Yeah, yes, and then you let it go on the rally.
Okay, so how do you let it go? How do you, my question was, what is the point of confirmation for you? Where do you
Uh,
confirm? Well, let's
I'm
say
not.
this is the spring.
I'm not that good of a Wyckoff student
I see. Well, I'm
to
thinking
be able.
that maybe like a breakout, like a local breakout between this after the sprint and the test. So if there is a resumption of this up move, then we definitely should continue and actually add to the position because this is an add-on point
Yeah.
right
Yes.
here. Yeah.
Yes.
Okay, so we are looking for the confirmation. Okay, this
I've
is
had.
great.
We're on Fang, right? Are you on Fang? Oh no,
Um,
I wasn't looking at. I
on the
wasn't looking at
portfolio.
you.
Yeah. Well, let kind of like finish here just
Yeah.
one more item. What I thought that was mentioned many times, but maybe we are overlooking this point. Um, the difference between, let's say, a secular sprint and
Hmm.
more of a sprint in the bull market already. because the springs in the bull market in the previous or in prior leadership stocks, those are the best.
Those are the springs and uptrends.
Yes, springs and uptrends, exactly.
Yeah.
And
So LYB would not be one of those, but it made a 5-year spring, was yielding 6% down there.
Mhm. So think about like what's the difference, right? Well, first of all, there could be a difference in causality. Secular springs are going to have, secular type of causalities.
Yes.
Springs in the uptrend are going to have smaller causality because those are reaccumulation points,
Yes. Yes.
and
Yes.
they're going to require even less effort and less momentum to get out of them. But they still will require some effort of absorption. This is actually really good.
Well, Roman,
Yeah.
from where I come from, when I was an institutional salesman, we were a value shop. So I just like cheap.
Hmm.
It's just been, that's just the way I was brought up in the stock market.
Well, yes, and we want to understand that mentality because, the mentality of value is still pretty much rules the markets. The mentality of momentum sustains the trends. So
Mm-hmm.
we want to
Yep.
understand, how could we, how do value investors operate? What are the points where they buy? And I think this presentation is just perfect. It's kind of like a look inside of institutional mind and how institutions are buying value, which we call a spring.
And Roman, our bond guys will also refer to spread and volume too.
Hmm.
Um, and bonds are different, but they're really hard to buy as opposed to stock because they're so illiquid. So you look for spread and volume.
Right. So there is some liquidity problems in this market,
Oh,
right?
huge!
Yeah.
It's huge.
So you have to navigate also in terms of like, if I'm getting into this position, am I going to get out, even if the
Yeah,
price moves
no
in that
question,
direction? Yeah.
no question,
So there should be
no.
some kind of assessment as to the, what levels of liquidity, you could have, and then what kind of weight per position you're going to have as per that liquidity, stuff like that.
No question. We have to study this to know
Mhm.
if it's a bond. If we can't trade bonds, we don't have a business.
Right.
So whatever we trade, we have to be able to sell out of. So we look for big liquid bonds, but even in the big liquid bonds, they're hard. They're hard to. Like many things in life. It's very easy to get into things, much harder to get out. So
Yeah.
you can buy you could buy any bond you want at a fair price, maybe, but try selling it. That's the problem.
All right.
So yeah,
Okay, well, Ted, this is great. This is a great presentation. Thank you for this unique view for us. You kind of like uh, uh, bring in both, institutional knowledge and your experience, and then also understanding of the Wyckoff methodology and how we look at things. So it's just very, very unique for us. So we.
yeah, it's not perfectly Wyckoff, and I'd like to get better at Wyckoff because then there'd be more, uh, just be more trades
Hmm.
and better ones. So
All
anyhow,
right.
so there you are. So
Okay.
I can continue driving and I'll just listen if I
Absolutely.
can.
Enjoy the class. And thank you very much again.
Great.
All right. I think I muted Ted. Oh, no, he muted himself. Well, Ted, thank you very much, and just enjoy the class. Well, I think that this type of presentation, um, we probably could have so many with people who are on the institutional side and they're using, let's say, technical analysis, or they're using like a methodology in particular. It makes a lot of sense where TED would be looking for candidates. It's that at that point of institutional value, they need to be so efficient because they need to produce good matrix. throughout the year. Otherwise, they're not going to have business. So therefore, there is a lot of thought that's going in, in their head as to where exactly they are buying. That's a really, really good knowledge. All right, great. Let's look at the markets really quick. So we probably would agree that tariffs is probably, as a story, is going away, at least short term, at least with phase one. I think that we are going to have some kind of ups and downs there because it's not resolved completely, but the coast is clear. Brexit, and I was talking to one of our students and my friend, and he lives in London, and I was asking all of the Brexit sentiment news, and even though a lot of people were objecting to the Brexit itself or how it's happening, the markets actually were encouraging. The London market has rallied at almost 2.5% after the vote, and after very decisive vote for Boris's party. So it's probably a non-event as well. There is a change of perception, and we'll talk about this tomorrow in the WMD class. Then what are we left with? Fed. Fed is accommodative, and there is really nothing on the horizon in terms of the unexpectancy of the Fed behavior. Economy, well, it's slowly growing, it's not overheated, and that's usually a really good thing, not to be overheated, but at the same time, grow. So that would suggest that with other problems going away, then, there is a room for a run, a room for a rally. And then obviously, we have the market itself. And what does the market say? Again, listening to quite a lot of people just because, I have to, I'm hearing a lot of negative sentiment. Oh, this is still going on, or this is, still going on. And look, this is an upthrust. I don't see an upthrust yet. If we would be talking about an upthrust, we probably would be talking about an upthrust somewhere here. But hold on a second, they did talk about this here. Okay, well, maybe a more meaningful upthrust that starts with this change of character. They did talk about this. No, it's not that upthrust. Upthrust is an action where you would have an attempt to go up and then almost immediate come back into the range. And here we would have to look at the slope, actually, So the upthrust would be more like this. Not a very good representation of the upthrust. So we would be looking for something like this, and it doesn't happen, or at least we don't see it yet. We are actually in the trend channel, and we are just facing the resistance that is based on this point right here. And this is just in the lower part of the trend channel. If we're going to overcome here and we're meeting some resistance because of different trend lines right here, different points of resistance. But once we clear this point right here, and I think we're going to have like a little bit of a pause around 32, 32.50, then we don't have anything here. And we're going to accelerate really fast into 35. At least that's how it looks right now, the way how it moves. And then obviously we want to understand where the leadership is. So technology is the leadership. I still would stick to Russell as well because it seems like it wants to explode. VXX and VIX are confirming the rally, so there is no bearish institutional hedges that are coming in, and the ones that came in were unwinded literally in a week or so. So, and that helped to push the price even higher. Oil, the latest update that I had for you guys yesterday is that we are trying to break out. And the way how I look at supply that came in and supply that is not coming in at this level, it just basically suggests that supply has been exhausted. And if supply is exhausted, then we probably will have a breakout, or at least an attempt. At least we'll have some kind of probing attempt to overcome this sloping resistance. And if we do, that's going to be a little bit dramatic. That's probably going to have some kind of acceleration. And I think acceleration through 62 with a lot of supply coming in and then into 64. I would expect that we probably would make a slightly higher high and still would stop somewhere at 64. We're kind of going in this slope here. So 64, rejection, and then high, something like that. But definitely it feels like it wants to accelerate. This would be in line with the market acceleration as well. So if market starts to run away, I think, that will be on the some kind of, well, let's look at the economy, let's look at earnings, and it still would suggest that the prices are going to be higher and they're going to, bump it up. Gold, I still don't see a very strong edge here, so I'm just staying away. Remember how Wyckoff would say, if in doubt, do nothing. Well, it's not like we're in doubt. We just don't see opportunity. So I would say when you don't see an opportunity, stay away. Don't try to kind of like create any trades. Having said this, I think, probably if we are trying to commit to the upside, we're probably gonna go to 1540 and then meet some kind of resistance. And that would suggest that we might create a trading range. Another possibility here is just a really big capitulation on market that is just going up, 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 and it runs away. And then gold is just basically loses its value as a instrument of safety for a moment, but it still stays in some kind of trading range that would allow the gold continue its secular, drive up. So I don't see that edge. I'm long-term gold, but I'm not trying to pick any spots here and would trade cautiously to the upside if opportunity presents. All right. That's it for the market update. Let's go to some questions. Chris is asking, could you show us what settings are required to show a rate of change, relative strength, and horizontal volume on stock charts as I'm about to move across from my old UK chart provider? Okay, and then a second question, if possible, in the last class of the practical, show us what a reverse trend line is. Okay, great. So we're doing the relative rate of change, we're doing relative strength, and then we're doing horizontal volume. Okay, so the one that we don't have is the volume. So the volume, horizontal volume, is called on stock charts volume by price. Here we go. So here are all three of them. So let's just kind of like look at what we have here in the settings. So horizontal volume, volume by price, and it's going to be in overlays. Then under the indicators, you're going to have a relative strength. So you're going to choose price, and you're going to choose, for instance, you're going to write $ symbol, division sign, and then a market proxy that you want to use. So for instance, I could say symbol and I want to use, let's say, VTI as a market proxy. Then I want to say, well, instead of the total market, I'm going to use this sector. For instance, I'm going to use technology sector. Well, I don't want to use technology sector. I want to use a group. And then I would choose some kind of group that fits the description, the classification of the stock charts. But then maybe I don't want to use the group either. And I'm going to compare everything to Apple. And that's how you build that relative strength line. If you would like, you could use, and in the overlay to the relative strengths, you could have a moving average, and you could identify the parameter for that moving average. And usually I do have, because it's right away a definition of the trend, so you kind of easily see what the trend is, and the moving average is trending, sloping down, trending down, and then the price action on this relative strength is predominantly below the moving average, so it's a downtrend. Rate of change, this you could change. 21 is going to be your short term, so this is 1 month. 63 is going to be your quarter. 252 is going to be your year. And usually these are the parameters, and I also use this for moving averages as well. Why this? Because these are institutional type of time frames: a month, a quarter, and a year. And usually we would like to see, on the institutional side, deterioration within 2 quarters of absolute return and relative return. So when we see that type of deterioration in 2 quarters, we probably would be thinking that the institutions would be probably giving up on their positions after this type of performance. All right, so I think that's it. We've covered that. And now reverse use of trend lines. Okay, and let me just get rid of maybe this volume, because it just occupies a lot of real estate here for us. Okay, so how would we be doing the, let's say, conventional way? And let me just annotate this chart so that we would be accurate. We would take a significant high for the downtrend and connect it with the next significant high, which comes either here at this high, or this high. And you kind of have to play around with this and just kind of like see what works. So I would say like this is probably the line. Just gonna put a thick line like this so that you guys would see. Why here? Well, because this touches it and this touches it. If I would be using this one, it would not touch both, or just have kind of like this upthrust type of action. And then after this, what we want to do is, okay, well, just to kind of check, would that work on the lows? And if I would go like this, it's probably gonna look like, yeah, it's not working. But in fact, I would say that it actually does. Okay, so here's our conventional way. And then, here with the oversold, yeah, this would be the line. So let me just do this again. So this is the conventional way how we would do the trend lines. Significant high, confirmed by this high, and then a parallel line that catches the majority of the support points, and then has an area of the oversold condition. Now, how would we be drawing the lines that would be that would be reversed lines, right? Let me just take this color. So we would identify first significant lows, and then with that, we would draw that line first. So please note that we are not using the highs in the downtrend. And then we would try to find and connect the highs. And in this case, I can't find anything except maybe for like this level right here. So this would be the use of reverse trend lines. So in other words, conventional way, you always would be looking for your first point, the highest or the lowest point in the trend, and then the highest or the lowest point, you know, of the same bias, and that would be the conventional way. The reversed use of trend lines, you would be looking for the opposite to the bias, the extreme on the opposite side, and that would be in the case of the downtrend oversold conditions, right? So a support. Let me pick another example. I'm not loving this example that much. Okay. I've actually been working a lot lately on trend lines, and it's a fascinating creature. By the way, please note that this is logarithmic. So I actually find more and more value in using logarithmic charts as a percentage chart in the use of the trend lines. So here we would be probably connecting, you know, these highs. You would be thinking, okay, all of this has that type of stride, right? Then we see how this line is broken into two parts. And it's not that we've broken the uptrend. We just traveling at a different stride now. And here it is. And I would say that this is our mean here. So if that's the case, I would just go and right away check the upper part. Okay, overbought condition. I see it's working. Okay, how about oversold condition right here? Working too. So this would be my trend with the mean in the middle. Okay, something like this. And then something like this. So that's the true trend channel that the price, you know, has been in this uptrend. We could definitely have other definitions, right? So we could maybe look at, and some of you would be saying like, why not this? Could we do this? Yes, we definitely can. So this is the conventional way, and you know, you have quite a few points here. 1, 2, 3, 4 points before the break. So for the long-term investor, you could have that stride. But probably this one is going to be the most effective. Now the key here, and something that I'm going to do, you know, for the next WTC cycle, the key here is to define where the mean is. And this is what I'm finding visually is the best tool in identifying the channel itself. And you want basically this mean, the price, to kind of like, you know, hug and always find some kind of support and resistance at the same time. The more of those support resistance points you can find on the same line, the more it's going to mean that this is the mean, this is the stride of the trend, and then everything else, you know, is just around it, overbought and oversold conditions. And then you also want to, you know, project some of additional lines, you know, when you have extreme overbought and oversold conditions. So something, you know, exciting when we look at it like this. All right, so hopefully we've resolved this. Let's go to the anatomy of the trade. And here, guys, I'm gonna ask you a question. What do you guys think? Should we keep this position or not? And this is our last time when we look at as a group at this stock. So I want you to give me your recommendations, let's say, for slightly long term, let's say going into the first quarter of 2020. The question from me to you, would you keep this position or not? So we're not talking about the stop losses. I'm just saying that we are holding this position right now. What does it mean? Are we keeping it into, let's say, the first quarter of 2020 or not? And then the second question is going to be, if we're keeping this position, then what is our stop loss? So write it down. Let's see where we are with that. All right, guys, what do you think? What are your answers? All right, and I would say that, my expectation was that majority of you are gonna have the same type of the decision. If you're keeping this position, please let me know where the stop loss is in your opinion, where we should have it. All right. Okay, so all of you are saying keep it with different type of stop losses. And they just range. They range from 240 and then to 180. So kind of like a whole spectrum of stop losses. Okay, so let's deal with probably the first decision here. Are we keeping this position or not? All of you are saying yes. I would probably say yes as well. Why? Well, we're not going to go through the whole logic. We did the analysis many times. It looks like we have a minor sign of strength, and now the price just, reacted to the downside, but recovered relatively quick, and we're staying still in the upper part of the gains that we've had since 180. So that's a bullish sign. That's a really good sign. So that kind of keeps us in the position. The question of the stop loss is much more complicated. On the one hand, we want to move the stop loss to somewhere below 220 at the time when we have the breakout. We don't want to necessarily have it here because right now, because we could have a retest and then a continuation, something like that. So therefore, we need to look at the second point of support, where we are probably going to be at the point of a catastrophic failure of the trade. And by the way, our original stop loss is here, so it's just a matter of where actually we are moving that stop loss to. So where is that second support level? Where do you guys see that? So the first support level is at 220. Where is the second support level? Okay, 190, below 190. Very natural spot right there. Larry is saying one halfway to 190. Interesting. Okay, so Larry, is it going to be somewhere here at like 205? Something like that? Okay, great. I would go for 205. Larry, could you explain why? What was your logic? why would we be looking at 205 as kind of like this point of, yeah, we could move the stop loss and be closer to break even, and then at the same time, have enough room for the price to move. But what's the rationale there? Why this level? I wonder if Larry is going to have an answer for us. Okay. Well, I'm not sure, Larry, if you're typing in or not, but so if we're thinking about the second support level, then the question is, where is that second support level? So probably somewhere here in this action. And let me just see. Have reversal significant bar. Yep, that came from France. I don't want to lose most of my gains, Larry is saying. Yeah, absolutely. So if we've entered, let's say, on this bar right here, let's say at the close, and our stop loss was here, by moving it slightly above, we're effectively decreasing our risk by a factor of 2, right, by 50%. So we should be somewhere here. And if you're a little bit more conservative, put it slightly below 200, so 198. So somebody had it. Let me see. I think Sharon had it at 198. Yeah, so that would be a logical place to think that if the price would fail there, then it's a catastrophic stop loss for us, and we would be losing half of our risk. So not a full risk amount. So probably that would be a strategy. Well then, what about any add-ons? Would we add here to the position? I mean, do we have a conviction? If we're keeping this position, we must have the conviction that the price will go up. So then therefore, is there any place where we could potentially add to the position, if the price confirms a movement to the upside? Where do you guys think we could potentially open additional position? Rick is saying 240. So assumption here is that we're going to wait for some kind of higher low. 270, Larry is saying, on the breakout. So two different strategies. If the price breaks out of ledge, Sharon is saying, okay, so something like this, and ledge, I would assume, is this. Yeah, so all of these are valid strategies. So we have, a limit buy strategy, a reaction. So in this reactionary strategy, we want to see some kind of reversal. This would be a point of entry. We could also have some kind of breakout strategy. Absolutely. We are still not at the point of the resistance. And most likely after this drop, we probably gonna make a new high, and we're gonna make an all-time high in this stock. Okay, well, it's definitely been a lot of fun to go through this stock, to go through this trade. Thank you guys so much for your pick. And even though it came late, it was a really good pick. So most likely the next group will select something else, of the interest to them. So we will have to see which stock it's going to be. And if you're already, in that new group, think about the stock that you would like, to trade. There are definitely a lot of great stocks to trade. I personally would probably, like, if I would be assigned to this assignment, I probably would trade Roku right now. That's probably my favorite stock right now. Okay, on some sort of reaction, but where and when? What about the big down bar from 260? Yeah, so let's go a little bit into this. Franz has a really good point. This bar right here has emergence of the supply and an ability of the supply, to produce even more damage, although it's been damaging, right? So usually that supply is going to require some kind of retest. And with this retest, we probably would see that higher low that I believe Rick was describing, if we go to 240. So if that happens, reversal bar right here, if we're going to have some kind of sprint situation and then come back, then we probably would need to assess it at this point just to see whether we would want to add to the position or not. Yeah, and Franz, good question, right? Where do we put the add-on? That should be the question on my mind for sure.